By the time you actually read about layoffs in the headlines, the real story, the thing that caused them, is already long over. The cause isn't found in an HR department. It's found in the loan books of banks. So in this explainer, we're going to show you the direct mechanical link between bank credit and job security. So let's get right into it. How are bank loans and job losses actually connected? This isn't just some vague correlation. It's a predictable cause and effect chain. And once you know what to look for, you can see it coming from a mile away. You see, the link is incredibly direct. It's a chain reaction that starts long before anyone is talking about it. And our goal here is to show you exactly what those signals are so you can spot them yourself. Okay, let's start with the absolute foundation here. Why exactly is a credit crunch such a direct threat to jobs? Well, first, we need to be crystal clear on what a credit crunch actually is. A credit crunch is pretty much what it sounds like. Banks suddenly and sharply reduce the availability of loans. They get more cautious, they tighten their standards, and they effectively turn down the financial spigot. This isn't a gradual slowdown, it's a shock to the system. Now, for most companies out there, especially the small and medium-sized ones that really power the economy, bank loans aren't just for big expansion projects. They're the lifeblood for day-to-day operations. Buying inventory, managing cash flow, and most critically, making payroll. When that credit lifeline gets cut, the effects are immediate. And we're not talking about a small effect here. One major study found that a drop in the credit supply was directly responsible for a quarter of all job losses during a crunch. Think about that. That is a massive, measurable impact. Credit isn't just a factor. It's a primary driver of the job market. Now take a look at this chart. It shows the connection perfectly. The dashed line, that's the credit supply available to a company. The solid line is the employment at that same company. Just watch what happens. The moment the credit supply drops, employment follows it right down. They move in almost perfect lockstep. So if we're going to boil this down to a single number, this is it. For every 10% drop in the supply of credit, employment falls by 3.6%. This is what makes a credit crunch so real. It's not some abstract banking problem. It's a jobs problem. Okay, so we've established that a credit shock is powerful, but its impact isn't spread evenly across the board. Certain jobs and certain types of workers are far more exposed when that credit starts to dry up. The clearest dividing line is between temporary and permanent workers. When a company feels a cash squeeze, the simplest, fastest, and cheapest way to cut costs is just to not renew temporary contracts. It's a much easier first step than going through the costly process of laying off permanent staff. Essentially, in a downturn, temporary workers act as the economy's shock absorbers. And the research points to other specific groups that are especially vulnerable. You've got employees at small firms, because their companies just don't have as many financing options. Younger workers and those with lower skills get hit hard, often because they're in those more flexible roles. And, of course, if a company was already deep in debt before the crunch, well, its employees are in a very precarious position. The underlying logic here, it's pretty consistent. The risk is always highest for people whose employers are financially fragile and whose jobs are seen as the easiest to cut when times get tough. All right, now for the most practical part. Because this whole process is a predictable sequence, it means there are leading indicators you can actually watch. Here are the 3 early warning signals that a shift is underway, long before you'll read about it in the news. The sequence is really clear and logical. First, the banks tighten their lending policies. That's signal number 1, the first domino. Second, that policy change starts to show up in the data as a slowdown in actual credit growth. The flow of money is tightening. And third, that financial tightening hits the real economy, and hiring starts to weaken in those vulnerable sectors we just talked about. And this chart, this shows that first signal in action beautifully. The red line represents bank lending policies. The blue line is actual credit growth. Just notice how the red line, the policy, tightens months before the blue line, the actual credit drops. That gap right there, that's your early warning. The policy change is the cause, the drop in credit is the effect. So why does understanding this chain of events really matter? Well, it's about moving from a reactive mindset, where you're just hearing about layoffs after the fact, to a predictive one, where you understand the forces that actually cause them in the first place. What often seems like chaotic, random economic news is really just a system at work. It has predictable inputs, like bank lending standards, and it has predictable outputs, like changes in the job market. And when you understand the mechanics of that system, you can see right through the noise. The key takeaway here is this. Understanding how this system works gives you a real informational edge. While most people are just waiting to react to the news headlines, you can see the pressure building up in the financial system and know what's likely coming for the real economy, weeks or even months ahead of time. So it all comes down to this. Now that you know the direct link between credit and jobs, and you know the signals to watch for, the only question left is, are you watching them?